Welcome to the May tax update. It's great to have you along. My name is Malcolm Pengelly, and I'm your host for this afternoon. Could we have the next slide, please, Jordan? Your speakers are Sadiq Hashmi, who I think a lot of you will have met, at least online on the tax line. He's going to deal with the direct tax topical matters, what's been hot in the last month. We also have Marvin Reynolds, who's a VAT director and also a consultant on the tax line, who's going to run through some recent VAT developments. We have Siobhan Waters, who is going to do our first topical tax session, one of the longer sessions on the national minimum wage update and how to avoid getting into hot water with that. Tahir Ibrahim, ably supported by Phil Reynolds, whose picture we couldn't fit on the page, but so they are a partner and principal respectively in the private business group with a number of non-domicile clients, and they're going to take you through the changes in the spring budget to the non-domicile regime anticipated to come in April 2025. Next slide, please, Jordan. So this is the agenda, the news items, followed by the national minimum wage, followed by the non-dom changes, and a Q&A at the end. We can pick up questions at the end of each of the substantive sessions. If you would, as usual, please pop your questions into the Q&A section of your screen. We'll pick them up as we go along. And I think without further ado, next slide, please. Over to Sadiq and Marvin. Thank you both very much.
Thank you, Malcolm. And if you go on to the next slide, we'll see some direct news items. Not anything major to report. I'm just going to go through an update about the Pandora papers and a couple of cases, recent cases. So HMRC is sending more nudge letters on the Pandora papers. So as part of its continuing compliance responses to the Pandora papers data leak, HMRC is issuing a further tranche of letters to some wealthy individuals that it suspects has undisclosed tax liabilities. So the letter will name the offshore entities that HMRC believe the taxpayer has connections to, and recipients will have 60 days to respond to the letters. Though no response is required if they believe that no tax is due. The letter sets out the various disclosure facilities and what penalties might apply. That's something you may see. It received quite a lot of publicity when it first came around. The second thing I want to speak about is a recent case. It's Tan versus HMRC, and it's about negligible value claims. So the taxpayer held shares in a company of which she was a director. She stated in a return that they had become of negligible value and claimed a capital loss of 150k. HMRC in the first year tribunal denied her claim. She had acquired the shares by capitalizing her director's loan account. The first year tribunal found that at the time of acquiring these shares, the company was in fact insolvent, based on its accounts and later being struck off. So the shares were actually worthless at acquisition. And remember, to make a negligible value claim, the shares had to be worth something and then had to become worth negligible afterwards. But in this case, the shares were worthless on acquisition as a starting point, and therefore no capital loss arose from them still being of negligible value. The other case I wanted to speak about is Beard versus HMRC, and this is upper tier tribunal. It agreed that Jersey company distributions are taxable to income tax, UK income tax. So in this case, the taxpayer held shares in a company which is incorporated in Jersey and domiciled in Switzerland, and was also listed on the London Stock Exchange. For 5 successive tax years, the company made payments to the shareholder from the share premium account, and on one occasion gave him additional shares, which were treated as cash in this decision. The share premium account was funded by a restructuring. So Jersey law does not use the term dividends. The taxpayer argued that the payment were capital receipts, or alternatively, dividends of a capital nature. The First Trade Tribunal considered the history of the law on dividends in both Jersey and the UK, and the current position in both legal systems. Ultimately, it determined that although the payments were made out of the share premium account, they were income dividends. The First Trade Tribunal noted that the form in which the payment is made must be taken to determine its character. The mechanism chosen in this case represented an income distribution in Jersey law, and therefore it was taxable in the UK as a dividend. The taxpayer appealed against the findings that these were dividends and of a capital nature. The Upper Tier Tribunal dismissed this appeal on all the grounds, finding that the First Tier Tribunal had analysed the case in the correct way. So they were all the direct items. Now over to Marvin to talk about VAT.
Okay, thanks, Sadiq. Next slide, please. Okay, so I'm going to talk about some recent announcements from HMRC. Firstly, in respect of the interpretation of VAT and excise law from the 1st of January 2024. As many of you will know, the UK VAT legislation derives from what is now known as the Principal EU VAT Directive, and the UK courts have been bound by the principles and rights arising under EU law and decisions of the European Court of Justice. A key element is that UK taxpayers could rely on the direct effect of EU law. So if aspects of the UK VAT Act were incompatible with EU law, for example, where UK law had not been updated to reflect a European Court decision, taxpayers would be able to apply the EU law where the UK provisions were less favourable. There's been lots of uncertainty post-Brexit and the coming into effect of the retained EU Law Revocation and Reform Act 2023 from the 1st of January this year as to how UK VAT and excise law should now be interpreted. This legislation removed the supremacy and special status afforded to EU law in the UK legislation, so it's no longer possible for any UK Act of Parliament or domestic subordinate legislation to be quashed or disapplied on the basis that it is incompatible with EU law. Section 28 of the Finance Act 2024 introduced what's been described as a bespoke solution for VAT, also with effect from the 1st of January. And this is with a view to providing certainty and stability in respect to the operation of the UK VAT system. The primary purpose being to mitigate the risk of settled interpretations of UK law that were based on EU principles being challenged and relitigated on an alternative basis. Under this bespoke solution, UK VAT and excise legislation will continue to be interpreted in the same way as it was before the 1st of January 2024. So in theory, nothing should change, and it continues to be the case that rights and principles that have always been applied for interpreting UK law, including the principle of abuse, will apply in interpreting VAT and excise legislation. This ensures that existing case law can still be relied upon. HMRC has now issued a policy paper contained in Revenue and Customs Brief 4 of 2024 that clarifies its position. One new point raised is that the paper confirms, in HMRC's view, businesses will no longer be able to rely on the direct effect of EU law as was the case before. So if a UK provision is not compatible with EU law, it would no longer be possible for a taxpayer to apply that EU law, given that the UK legislation is now supreme. This will particularly affect the financial services sector, and HMRC has already started to amend its guidance in certain areas, such as the VAT liability of back office insurance services, where the scope of the exemption in UK VAT law differs considerably from established EU case law, such that affected businesses can no longer rely on the EU law. HMRC said that they've engaged with those sectors potentially affected by the removal of direct effect and will provide specific guidance as necessary where further clarity is needed. No doubt this will develop over coming months and years, and it'll be interesting to see whether further guidance is issued and changes made by HMRC in specific areas going forward. The next topic is HMRC's views on whether a business has an establishment for VAT purposes in the UK. This is important because it can determine the place of supply of a service and therefore whether UK VAT is due. It is also relevant when ascertaining the VAT registration status of a business. Over the last few weeks, HMRC has been issuing revised guidance in various areas on when they consider there to be an establishment in the UK. The term establishment is not defined in the legislation, but in accordance with case law precedent, a business would typically be established for VAT purposes in the UK, where the essential management of the business and the business's central administration is carried out in the UK, or where the business has the permanent presence of human and technical resources necessary for making or receiving supplies in the UK. So this would be where there are people located in the UK that make day-to-day decisions and operate the business. There can be some uncertainty, particularly where an overseas business incorporates a UK company, as to whether this can be established in the UK for that purposes. Relevant HMRC guidance used to state that they would normally consider a company which is incorporated in the UK to be established here. But they've now deleted this statement and added guidance and examples that confirms that a registered, serviced or virtual office alone is not enough to create a business establishment. This might be relevant, for example, where a company uses a third party as its registered office address, such as an accountancy or law firm, or uses a mail forwarding service, but has no other presence in the UK. So it follows that just because a UK company has a registered address in the UK, this would not by itself be sufficient to create a UK establishment. I've seen this causing problems, for example, where an overseas business sets up a UK company to acquire a commercial property in the UK and is VAT registered on that basis. But the company otherwise has no presence or resources in the UK. If services are provided to that UK company, where the place of supply is where the services are received, such as consultancy or accounting services, it's possible that the services are received overseas, such that the services should be outside the scope of UK VAT. And if UK VAT is charged in error to that UK company, it would not be recoverable as input tax. We're also seeing disputes in this area in relation to businesses selling goods on online marketplaces, such as Amazon. The practical issue here being that the marketplace itself may be responsible for accounting for the VAT on the sale under the marketplace liability rules, where the seller is not established in the UK for VAT purposes. We've seen examples of clients that have accounted for VAT under their own registration, but have then been challenged by Amazon over their establishment status, giving rise to uncertainty on the VAT liability of the sales and the compliance requirements. And if a seller can't provide evidence of its UK establishment, Amazon may then be responsible for the accounting for the VAT itself. And we further understand that some sellers have been removed from the marketplace until these issues are resolved. So to summarise, this increased focus by HMRC on whether a business is established in the UK can give rise to a number of practical issues. And if you have any overseas clients that have activities in the UK, care should be taken to ensure that VAT is accounted for correctly. And to finish off, I'd just like to mention a warning from HMRC in respect of VAT repayment fraud. We've seen reports of recent cases where taxpayers' bank account details have been amended on the HMRC portal without their knowledge, so that VAT repayments have been diverted to a third party. This has been possible because HMRC had received a letter or a VAT 484 form purporting to be from the taxpayer, and have merely followed up by writing to the taxpayer to say that their details have been amended, but not expressly referring to what has actually been changed. HMRC has recently confirmed that they're aware of this, and where they have identified fraud, HMRC have dealt with this, but they haven't necessarily informed the taxpayer. We're advising clients to check any notifications from HMRC about a change in details, and also to set up a process of regularly reviewing bank account and other details held on HMRC's VAT portal, particularly where the business is in a regular repayment position. Okay, next slide, please.
Thanks, Marvin. That's very good, very interesting stuff. We don't have any questions in the Q&A at the moment. Doesn't mean you necessarily escape. If people have got anything that crosses their minds in the next half an hour, 45 minutes, please pop them in the Q&A and we'll pick them up at the end. But for now, Marvin and Sadiq, thank you very much indeed. Next slide, please, Jordan. And Siobhan, it's over to you.
Hi, thank you. Hi there. So my name is Siobhan Waters. I'm going to give a national minimum wage update from what we've seen from the changes from the 1st of April and what activity we are seeing from HMRC. If I can have the next slide, please. So from the 1st of April, same date every year now, the national minimum wage and national living wage rates are introduced. So we've seen another significant increase. The rates there, apprentice and under 18s up to £6.40, 18 to 20, £8.60, 21 and over, which is the national living wage, not to be confused with the real living wage. That's the highest rate payable for 21s and over of £11.44. And accommodation offset of £9.99. Now, the significant change for that with the age bandings this year was a reduction to the over 21 rather than it previously being over 23s for that higher rate. What we know around this time is that the 1st of April is the date that's in people's minds. And we do know that a lot of workers might not understand, and some employers might not understand, that the new rates don't necessarily apply from the 1st of April, but from the next pay reference period after that. So depending on when a business pay reference periods land, the increase might not automatically kick in on the 1st of April, and that's okay as per the legislation. But what happens is a number of workers may well contact HMRC as they believe that their wage hasn't increased in line with the date that's widely publicised. HMRC traditionally will not act on them in that moment, but they will potentially follow up on that. So we do see a flurry of activity come May and June onwards as a result of people making complaints. Now, whether or not there's anything found in those complaints is up to obviously the process that HMRC will follow. But from my experience, we do know that it does take one worker to make a complaint, and HMRC will not specifically only look at that worker, they'll look at the whole business and potentially the whole group. So it is something that we are aware of and are speaking to people about just now if they do receive anything from HMRC. As we've seen the highest increase on this, we've also seen that there has been an impact for this 21 and over, which relates back to the apprentice rate. So the apprentice rate is applicable for those apprentices that are aged 19 or over in their first year. After that first year, if they're over the age of 19, they are entitled to their applicable age rate. And what this now is starting to come through is that there's a lot of apprentices that will reach that point where they will be entitled to the higher rate during the course of their apprenticeship. And it's key that employers understand the difference on that, and they are making sure that they're applying the correct age rate and not maintaining them on the apprentice rate. That is something that HMRC are very, very aware of and are very active in reviewing as part of any inquiries that they have. What it effectively means for businesses, though, is that there is a large jump between that 640 and 1144. And if they don't have the correct information around people's dates and people's effective start times of their apprenticeships, that can cause a bit of a potential inadvertent breach, and they can be caught out on that as well. Also, from the 1st of April, another change that was introduced to the legislation was a change to the live-in worker, the domestic live-in worker exemption. So prior to the 1st of April, anyone who worked in that category as a domestic live-in worker was not entitled to national minimum wage, and there was no enforcement to check that they were being paid national minimum wage. What we will now see is that HMRC do now have the powers to look at those domestic live-in workers. We may well see an increase in worker complaints from those that are in that particular role. And we may also see that those people that are in those roles who are working as part of the household may well be included in their employer's overall business. So although they don't work directly for the company, their payroll may be on that business. And that now gives rise to HMRC to be able to identify that through normal payroll records, and they now have the powers to ask questions around the domestic live-in workers. So although it's probably only impacting a very niche, small population, it is something that we do need to be aware of, because at some point we could expect HMRC to follow up on that. There's been a lot of campaigning for about 3 years to get that passed over to become part of the NMW legislation. So what we are having conversations with our clients just now, and what we're recommending people look out for, is having a true understanding of what national minimum wage pay is. Very often I hear people say, well, our payroll systems are set up, they'll pick up anything that is falling below national minimum wage. And what we are advising people is to check those payroll margins, because not all pay that's paid each month or each week counts for national minimum wage pay, and again something that can cause a potential technical breach. Where that is also becoming quite relevant with the age bands changing is that previous to this year, people who were potentially on a higher rate, and they were at that kind of 2021 age group, had more of a buffer if they had any salary sacrifice arrangements in place. These increases have effectively wiped out some of those buffers. So we are seeing people who've got salary sacrifice arrangements that are now having to be removed from those schemes. They might well have additional elements of pay over and above what's their effective hourly rate. However, because those payments don't count, it again reduces that buffer. So it has had a bit of a knock-on effect that we're already starting to see coming through now as well. What we are also speaking to people about is when the rates are increased, there's a lot of activity that goes on to make sure that that's in effect at the right time. However, there are some policies and processes that are then not looked at. And through active HMRC inquiries, we are seeing compliance officers challenge more and more on the policies and procedures that are in place. And what tends to happen is inadvertent local policies come into practice and people follow something that is not part of the national policy and may well inadvertently cause a technical breach against NMW. And some of that's around working time, some of that's around toil. Toil's not recognised under national minimum wage legislation, but may well result in an excess hours position. The key thing to remember on this is that doesn't just affect those that are impacted with an hourly rate of pay. It affects people who are on a much higher salary. So we are seeing HMRC look at people who are on salaries of up to £35,000, and they're looking at the hours that they're working cumulatively over the year, where they might not have overtime being paid for additional hours worked, and ultimately at the end of their calendar year, they could be in a position where they're effectively underpaid because they've worked additional time. That seems to be something that we are seeing more and more in any active HMRC inquiries. We're seeing a lot more activity from HMRC, which I'll cover in some more detail, but any letters that are being sent out now that would be a sort of nudge to ask an employer to check through a particular checklist of potential risks, we are now seeing HMRC follow up more with them being opened up into full inquiries as well. So we're supporting clients having these conversations, reminding them that it's not just about rates of pay, it's not just about reliance on your payroll software. There's a lot of conversations around things that will never touch payroll. And if the payroll person in a business is the person who's responsible for national minimum wage check, there may be things that fall out of scope of their remit to know. So a good example of that is uniforms and dress codes. HMRC love to find black shoes and black trousers as part of a dress code requirement, a worker having to purchase those items and subsequent replacement items. If they're not reimbursed and it's part of a policy and the employer's requirement to do that, then it has a knock-on effect to minimum wage. The payroll person doesn't see how much those black trousers and those black shoes are, or might not necessarily know the policy that's been enforced for a particular group of workers. So it is very key to make sure that it's not always just thought about as a rate of pay. We are looking at current compliance levels. So if HMRC come in, we know they're very active in many areas. How would you be? So a pre-HMRC check, are the compliance levels okay? And again, extending that more into not just the rates of pay, processes and policies as well, but also workers' understanding, because one of the main ways that HMRC open inquiries is through worker complaints. And in an inquiry, when they speak to workers, they will check and challenge information that the employer has provided as well. So making sure that workers have a true understanding of their effective rate of pay, and that helps avoid any inadvertent complaints made to HMRC as well. And one of the other things that we are finding more and more important is ensuring people are identifying potentially historic problems. They're willing to rectify those correctly, and they want to make sure that they put things right going forward. Failure to put things right from a historic point of view can result in HMRC looking at that process you followed, determining that it's incorrect, and they can still apply any penalties and the public naming. So there's financial and reputational impacts of getting it wrong when you're trying to do the right thing. It's not something that happens all too often, but we are seeing HMRC challenge more and more in the historic position and the corrections that's been done. They are going back now the full 6 years for current and ex-workers. So it is something that has a knock-on effect to that financial impact as well. And maybe I'll end up having someone being publicly named. If you can have the next slide, please. So the activity we're seeing just now, we are aware and have been for a while about a geographical targeting. So they've picked particular areas in the UK where they've went out. The process there is they send out a whole load of letters. Those letters are then followed up by a second letter which invites an employer to a health check. If the health check identifies any issues, they're given an opportunity to do a voluntary declaration and put that correct without having any penalties or naming. What we are also saying is that if people do not take part in those processes and go through the health check, there are visits where HMRC are coming out into the same area as well. They've got 11 locations that they've already been doing this in, so there's been a rolling programme of work. But last week they made us aware that the North East is their next target. The businesses in these campaigns are all businesses. It's not specific to one particular sector. So any Northeast businesses have the potential to be included in their activity. They have also been continuing with their sector-based activity. We've known that they have been doing this for a number of years, and they do tend to follow the same pattern, rolling through the same types of sectors. However, we are seeing them start to look at that wider sectors where they're not traditionally the ones where they have the most workers or the lowest rates of pay. So again, most recently we have just seen arts and leisure, which is also encompassing sports clubs. That's the latest sector-based campaign. We've also seen motor retail, accommodation sector, and care sector as well. So there are many different sectors that they are looking at and actively following up on the nudge letters that they've been sending out on. Whilst these campaigns have been going on, what they have also been doing is writing to workers either within the same geographical area or working within the same sector to make them aware of the obligations their employer has as well. And that in turn will lead to those workers looking at that, potentially identifying something that they feel is relevant to their role and raising that complaint to HMRC. So again, that complaint and that worker is not just looking at their own circumstances, it can lead to HMRC looking at the overall business. So there is a very big hive of activity coming out of HMRC just now. So we're certainly encouraging the proactiveness and making sure that when people are reviewing pay rate rises, pay rates, that they're doing it in line with ages, they're doing it in line with the correct policies, and they're making sure that their working practices are all compliant as well. I think that's my last slide, apart from any questions, if there's any.
We've got a couple for you, Siobhan. The first one is, do you take into account course fees for employees when calculating the minimum wage? Didn't say whether it was paid by the employer or the individual, so perhaps you could cover both instances.
Yeah, so in this sense, what can sometimes happen is if you are required to make a payment for a mandatory training course as a worker, you need that course to do your role, then that could potentially have an impact on your national minimum wage pay, your effective rate of pay. Now, the other side of that we do see that's quite common is when people have had that paid for by their employer and then they leave during a period of time where the employer then wants to recover that monies as well. So there's certain conditions within the legislation that does allow recoveries of those fees that the employer has been out of pocket for without having an impact to national minimum wage. But that depends on what's written in the contract and around how that person has left the business as well. So it's not a one size fits all. It can be quite varied. And it is something that I am aware that HMRC have had an issue. I've not been involved with anything, but there has been something, if you look in the local presses for Northern Ireland, where there was some fees relating to professional qualifications that HMRC had been looking at as well. So there are risks, but again, not a one-size-fits-all answer on that. It really comes down to contracts, what's happened in practice, and the expectation of the employer on the requirement of those courses to be done.
Okay, thanks for that, Siobhan. That's really helpful. This does look like a bit of a minefield, the whole national minimum wage system. Presumably, you actually get to go into clients who haven't been approached by HMRC yet, and they ask you to have a look at what they're doing. What do you find? Are they compliant, or are there issues that almost invariably crop up?
Yeah, I mean, it's very unlikely that people are out there, trying to underpay. That, it is those technical breaches that catches people out. So it is the things around those black shoes, black trousers, requiring a tool for the job that the employer hasn't paid. So those things that fall out of your normal HR or payroll functions tend to be where the hotspots where people can tighten up. But the big thing is, because there's so much HMRC activity in so many different sectors, it's keeping that proactive piece, and not only making sure you're fit for purpose in the processes you're taking as an employer, but your workers have an understanding. So salary sacrifice is a big thing. One of the worst examples, but it's a good example, someone who was earning £90,000, so never in sight for an NMW, thinking they would be underpaid, but they wanted to put pretty much all their salary into their pensions and had an effective rate of less than £9 per hour. Now, the employer didn't have anything to mitigate that from going through. However, what they could have done was to say to the worker, you can only put up to X amount, otherwise you would be underpaid national minimum wage, and then you can process the remaining part through a different way, which won't impact NMW pay. So there are things out there that are anomalies, but they are more common than you think, and the proactive piece is certainly highlighting a few things that just fall out of the normal top line of hourly rate against how many hours you're working.
Lovely. Thank you, Siobhan. That's all the questions on NMW for the moment.
Thanks.
So thank you so much. Can we have the next slide, please, Jordan? And we've got Tahir and Phil. So over to you, gentlemen.
Great, thank you, Malcolm. Good afternoon, all. Hopefully you can hear and see me loud and clear. We're going to talk to you this afternoon about the non-dom changes. This is certainly an area where we're talking actively to our clients about on a regular basis. And whilst we don't have anything much to point to other than a policy paper and a technical note, certainly no draft legislation, I think it is fair to say that people are trying to get to grips with what the detail may look like. And one of the points that we are making to our clients is that time will very quickly slip by. So where clients may need to take action, and hopefully we'll give you a sense of what some of that action might look like over the course of this presentation, they need to start thinking about what that action needs to look like sooner rather than later. But you've got two for the price of one. I'm joined by my colleague Philip as well, who's going to be running us through a lot of the details. So Philip, maybe you could just give us a sense of what some of the context is in terms of the non-dom changes and what the current government has proposed.
Yeah, okay, thank you. Yeah, I guess these clients are complete opposites of the national minimum wage type of clients, but anyway, they're still a target for HMRC and the government. Can we move on to the next slide, please? So a lot of you've probably seen all of this, but these are the very high-level announcements which were issued on the 8th of March on Budget Day in a technical paper. And very broadly, what they're saying is the concept of domicile is going to be abolished from the tax code. Now, we think it probably still will apply in certain areas, but the concept, which has been around for 200 odd years, and the remittance basis and all of that is due to be abolished, and people will be taxed on a worldwide basis. And you'll see in that first one, it says it will include settlor interested offshore trusts. So you may remember the previous changes in 2017 when deemed domicile was introduced, offshore trusts were considered, well, they were treated as protected from worldwide taxation. But these rules are going to apply to income and gains of the trust as well. We'll mention later on about IHT, where at the moment they're still protected. So the idea is that domicile will be replaced by a residence-based regime, and they're calling it a foreign income and gain FIG regime. I think everyone's calling it FIG, but we'll see if something else comes of that. But this will be a much reduced scheme, if you like. It's only going to apply for a 4-year window, and it only applies for those people who've not been resident in the UK. Well, initially for the previous 10 years. It may be that some people have been resident for a couple of years under the current regime, and they will probably qualify for 2 years of the FIG regime once we see the detail. That's what we think will happen. But if you think about newcomers, if they've not been here at all, they'll get a 4-year regime. That means they'll be taxed on their UK income and gains, and they won't be taxed on their foreign income and gains, even if they bring those to the UK. So that's quite interesting, although a 4-year window is pretty short, I would say, speaking to clients, and probably most people would agree with that. People were previously suggesting to the government, if it's going to be reduced, maybe it should go down to 10 years from the existing 15, or maybe 7. 4 years seems pretty short, but anyway, that's where we are at the moment. For those who are not deemed domiciled but are still able to claim the remittance basis at the moment, from April 25, when they switch onto this regime, there are going to be some transitional rules which we'll cover in the next slide. And then lastly, for inheritance tax, although nothing really was released in that technical paper, they said it's going to be subject to a consultation. What we hear from HMRC is that consultation may be released in the summer, but they're still planning at the moment for changes to IHT to come in at the same time as the income and capital gains tax changes. Again, it's going to be a residence-based regime, which we'll see in the next slide, I think. Can we move on to the next slide? So these are the transitional release for those who, as I say, for those who are not currently deemed domiciled, but will be moving on to this new regime from April 25, if it comes in from that point. So the first one on the left is about income, just for the 1 year only. The proposal is that only 50% of the foreign income will be taxed as a bit of a sweetener before they become subject to worldwide tax the following year. Don't know why it's not going to cover foreign chargeable gains, but that's what the paper says at the moment. Maybe there'll be some pushback, but that's one of the transitional reliefs. The main one, which we're talking to clients about, is this temporary repatriation facility, which is a proposed 12% tax from April 25 for 2 years. And this is on previously untaxed, unremitted foreign income and gains. We don't know how far that's going to go back, but let's assume it goes back, without limitation. That means this should apply to current deemed domiciled people, as well as those who are still on the remittance basis. And it may give some opportunity, which we could talk about later, to generate, income and gains now, whilst they're still potentially not taxed as a non-deemed domicile person, but benefit from a 12% tax rate over the next couple of years. So that's a big talking point with our clients. Obviously, we need to wait and see more detail, but that was one of the positive announcements to all of this. In the bottom left, this is just a comment really that at the moment it's unclear if distributions from offshore trusts would be within this potential temporary repatriation facility regime. If it is, that means there could be a lot of planning to be done this year, distributions perhaps, but weighing up the pros and cons of, do you distribute something from a trust and potentially have it exposed in your estate for IHT. That's a wait and see. But we've asked the questions of HMRC. Have got no response, but at least we've put questions out there on behalf of our clients because they want to know. And the last one on there is that there's going to be a rebasing election. It won't be automatic, unlike some previous rebasing positions for different circumstances. But an election for assets held at 5 April 2019, a peculiar date, but that's the date which has been put in there, which means that when these people are then taxed on a worldwide basis going forward, at least they'll have a higher starting point for CGT. Again, depends on what that looks like. It may be people choose to activate rebasing this year whilst they can, selling assets, acquiring other assets whilst they're still non-deemed domiciled, in case this sort of election for rebasing doesn't apply to them. Next slide, please. And so for inheritance tax, again, the proposal is for a residence-based tax, but in this case, it's going to be once someone's been in the UK for 10 years. So unlike the FIG regime, which is a 4-year window, this is effectively a 10-year window before someone, a current non-domiciled person is, so ignore non-domiciled, before someone is charged to worldwide inheritance tax. But interestingly, in the paper, they said there's going to be a 10-year tail potentially. So if someone leaves the UK, in theory, they're exposed to worldwide inheritance tax for the following 10 years. Again, this is a matter of some concern to clients. We've made the point to HMRC that how can you even sort of follow that 10-year tail? How would it work in practice? Obviously, nothing's been commented on because there's going to be a consultation. There'll be official comments later on in the year, but it's an interesting point because that one is of great concern to clients. And the last point on there is that if you have, this is a non-dom who's got an excluded property trust structure, under these proposals, which are the Tory proposals, inheritance tax protection would remain the case unless there was UK assets within the trust. But we'll see later that might change if Labour get in. The last comment on IHT I wanted to say was that a lot of people were talking about, if this is a residence-based regime, does that mean if you're, say, an expat Brit, you can escape IHT if you're out of the country for 10 years? All I would say is be cautious on that, because in the technical paper, it did say, yes, it's a residence-based regime, but there might be some, what they call connecting factors to consider. We don't know what that means. That might mean citizenship. That will all come out in due course. But I think just be cautious, because a lot of people have suggested that, oh, Brits can get out of IHT if they're not UK residents. That may not be the case. Next slide, please.
Thanks, Philip. And just taking stock of the current regime, which we've just covered before I covered this slide, I think the sort of feedback we've had from the clients we've been speaking to has been a bit mixed. But on the whole, I think whilst there have been clients who have already left the UK and others planning to potentially look at their options to leave the UK, based on what we've covered, I think the sort of majority opinion or the sort of overwhelming feeling was that whilst maybe there's opportunity for things to be better, the inheritance tax protections in particular for trusts meant that most people were sort of willing to accept the new regime. As I said, 4 years being a bit short, maybe there was more possibility there, but we certainly didn't see too many people throw their toys out of the pram, so to speak, and say they didn't like it. Whereas what the Labour Party announcements have said maybe has changed that. The other thing, just to talk about some of those transitional reliefs, Philip mentioned the temporary repatriation facility. we get the strong impression, and it's certainly the case. One of the vagaries of the remittance basis legislation was that it basically disincentivized anyone from bringing their overseas wealth to the UK. The TRF, temporary repatriation facility, is definitely doing the opposite. The current government wants people to bring and spend their wealth in the UK. The 12% rate is attractive, and I think taking a positive, that facility very much does encourage that. We await the detail. We understand that you should only pay the 12% on income or gains within those funds, not on the total amount remitted. There will be some relaxation of how to calculate what income and gains are contained in, within the account or within the assets. Again, devil in the detail and detail to come. But it does look positive. Philip sort of alluded to the fact that HMRC are in listening mode and they're doing listening events. We are certainly inputting into those events and staying close to the ground in terms of policy. But this is all with the big sort of cloud in the background that there's a general election on the horizon, and we expect it to be later this year. It needs to be by the end of January 2025. So whilst it's all very well that the current government have put out their policy, what is the Labour Party's view on all of this? If, as the opinion polls seem to suggest, the Labour Party has a very good chance of winning the next general election. So the Labour Party did put out a press release, although you had to request a sight of that press release, and it was only 2 or 3 pages long. And what that said is, on the whole, my words, not the press release's words, effectively they agreed with the Conservative Party policy, and the Conservative Party have more or less stolen a march on their policy. However, and I would hasten to add that one thing we need to bear in mind in terms of context around this is that the Labour Party is going out to try to win an election. So, we need to read their announcement with a political lens on it, i.e. they try to win votes. So their take on it is that the Conservative Party policy doesn't go far enough. It's a bit too attractive and too beneficial, and therefore they're proposing further restrictions. The main one being, as we've been talking about, in terms of inheritance tax and the carve out for non-domiciled individuals who have or do set up excluded property trusts before April 2025. The Labour Party and the Shadow Chancellor said they don't like that, and they will not have that carve out. So in respect of my earlier comments in terms of clients, that it has been a big deal for clients where they might have put away wealth into trusts previously, and that will be coming into the scope of inheritance tax based on the new rules as we've covered. And people who have accumulated wealth long before they came to the UK and being subject to worldwide inheritance tax after being in the UK for a period of 10 years. I've certainly had conversations with clients who have really feel that that would be a deal breaker for them, and that has certainly led to more inquiry from our client base and people we're talking to around options to potentially leave the UK. As the sort of third bucket says, effectively what that means is there's no ability for non-doms to shelter assets from IHT beyond the usual rules. So I think we certainly expected or foresaw a bit of a stampede to people thinking about planning before April 25. Depending on the view, and it comes back to my point when I opened the session around you need to engage with clients in conversation, need to take reasoned views. Whilst the Labour Party have put this out, I still think clients need to be thinking about what they do and whether they still think about setting up a trust prior to April 25. But there needs to be real-time advice being taken, and if clients wait for certainty, who knows when that certainty will come, and they could lose an opportunity, or the window of time will close to do anything. The other points the Labour Party have mentioned on their press release. The benefit of the 50% transitional relief will be curtailed. Again, they see that as a unnecessary concession being made to taxpayers going into the new regime for the first year. They want to incentivize people to be able to invest in the UK in the first 4 years of residence under the new regime, and they say they will incentivize that. Details to be confirmed. And as I was talking about the temporary repatriation facility, the Labour Party likes that, and they want to actually see that extended. I guess the way the current policy works is that regime is in place for 2 years. What happens if a taxpayer doesn't make use of the window for whatever reason? It leaves a legacy of the current remittance basis regime for an unknown period, an indefinite period of time going forward. So the Labour Party want to try to incentivize people to bring all that money to the UK, thereby, effectively stopping the legacy of the remittance basis regime at some point in the nearish future. Next slide, please. And I think it's back to you, Philip.
Yeah, thank you. Offshore trusts. I mean, we've talked a lot about trusts, I think, so far, but there are just a few things on here to think about. So even if trusts are looked through from April 25 on income and gains, on the set law, the pre-April 25 income and gains are still available to be matched to either the settlor or other beneficiaries in the future. So there's still going to be a need to maintain records of income and gains pools and all of that kind of thing as well. I mean, I think trusts, really, we need to think about over the course of the next year, and once we see more detail, what to do with them. Particularly given Labour's proposals that they're going to be a look through also for IHT. So, it may be you want to look at the terms of the trust deed. Think about whether the set law should be excluded. What effect does that have on a tax point of view? It may be quite good from an income tax point of view, for example. Maybe the trustees want to start thinking about investing more for capital gains versus income, from a tax point of view. There might be some actions the trustees could take on rebasing assets within the trust. Maybe they can again sell and buy assets and get a step up in basis, because there won't be an automatic rebasing, unlike in previous changes, say back in 2008 or the elections we talked about for personally held things. And ultimately, for these offshore trusts, it might be worth thinking about what if they were brought onshore? What's the effect there? Because maybe the set law could become a trustee and it doesn't become a problem, or like it would do at the moment. So lots to think about with trusts. I think that the main thing is you've got to keep looking at them this year, think about it, see what the rules say, and talk to the trustees, talk to the clients. Next slide, please.
Perfect. I think I'm covering this one. So I am conscious of time. We put a potential timeline on the slide, but to be honest, it's all up in the air. As I've said, HMRC are going through listening events at the moment. They're very much in listening mode, and BDO has participated in those. If people go along to them thinking they will glean more detail, I don't think that's the case so far. It's HMRC just taking on board what professionals in the industry are making of it, and sort of the feedback they're getting from their clients. We've been hoping to see draft legislation at various points. It's still to come. And the latest we're hearing is that maybe it'll come over summer. With that said, the summer recess for Parliament is on the 23rd of July. Doesn't give a lot of time, bearing in mind that, as Philip mentioned earlier, time for consultation on inheritance tax rules, that requires the draft legislation to be released, and you would expect at least a 6 to 8 week window for a consultation period. That window of opportunity and that time is very rapidly moving, sort of closing. We've touched on the general election, how all of that might impact on these changes. And of course, we want to have actual legislation, ideally long before April 25, and these rules coming into effect. As Philip sort of alluded to, assuming the income tax, CGT, and inheritance tax changes all come in at the same time, it really doesn't leave a lot of time. And I guess looking back to 2017, the worst case scenario is in some cases the changes actually come into effect before we've got actual legislation with royal assent, and that's not an ideal scenario by any means. Next slide, please. So if you're speaking to clients who have had enough, and I do think we have a responsibility in the industry to sort of look at this in a balanced way. And I would say that there is opportunity for people. Firstly, people moving to the UK for the first time under the regime, but we also need to be realistic and talk to our clients about options. And some of those clients will be looking at, especially if they're internationally mobile, maybe their children are of a certain age, they've sold down from business interests in the UK, they may be looking at where they might be able to go. So we've covered 4 main jurisdictions on the slide, all within Europe, which are attractive and our clients have been asking about. I would add Monaco to the list, which has had a bit of a revival in terms of, I certainly hadn't been being asked by my clients about Monaco for a while for various reasons, but it is cropping up more again, and Dubai crops up quite often. And I think this really plays to BDO's strengths in terms of our international network. Myself and Philip work with our colleagues in each of these jurisdictions on a day in, day out basis. And we're working with these colleagues in terms of live client scenarios where clients are working out whether to move to the country, what they need to do, both from an immigration and a tax perspective, to try to make this work or see if it's a viable option. We don't provide immigration advice in the UK firm, but some of our BDO counterparts do provide immigration advice, so it's a case-by-case basis. But giving you a very quick sense of the tax regimes that might attract people to attract clients to these regimes. Spain has what's dubbed as the Beckham law, which is still there. The taxpayer needs to spend at least 183 days of the year in Spain, or otherwise be able to show that their centre of economic interest and vital interest is in Spain. It's not a passive test. They need to be employed and undertaking gainful activity in Spain. They have had a couple of relaxations. So, for instance, ownership requirements have been relaxed in Spain. So I do think Spain has become even more attractive. Portugal remains attractive, and whilst the NHR regime has been pared back to an extent, it's certainly not dead. It may be dead for passive investors looking just to buy property in Portugal, but for your active, business owners, people in the tech space, people looking to do remote working, Portugal is very much open for business from what we understand. Italy's, talked about a lot. The flat rate regime is very popular. A flat €100,000 per annum fee, the ability to extend that to family members for payment of an additional €25,000. But effectively, you can shelter non-Italian income and gains effectively, and the regime works very well. Switzerland, we know, it's been around for a long time. It varies from canton to canton, and we've got advisors who can advise on all the cantons. And just talking about Dubai, they are introducing obviously taxes, corporation tax, VAT, or they have introduced those taxes. No direct taxes at the moment. I do think you need to speak carefully to clients about the sort of non-tax factors in terms of Dubai, such as weather, doing business, cultural considerations, that sort of thing. But from the clients I talk to, more and more people are enjoying Dubai. They get used to Dubai, and it is actually probably the number one destination that people are inquiring about. But like I said, if the client hasn't spent time there, it's definitely worth having those conversations. So as I said, we can certainly work with clients and advise on working out their plan of action as to where they might be able to go. We referenced BDO's Global Opportunities Report, which we released before all of this was kicking off in a detailed way. But there's some really interesting and useful information in that report, which is available in the public domain. I think that's the end of our part.
Lovely. Thank you, Tia, and thank you, Phil. Just one question I think we've got time for, and probably one for you, Tia. Do you see the use of insurance wrappers being more popular? Should this regime come to pass, and is it something people should be thinking about at this time?
Yes, of course, we can't give investment advice, and that's not an investment advice question, of course. But I think what I would say is that there's a variety of options that clients should be spoken to about. We've covered some of them, and Philip covered some of them as well. I think a life insurance wrapper could be a potential solution, with a couple of caveats. It's the cost element needs to be factored into, and the fact that when the wrapper comes to an end, it's income tax treatment versus as opposed to potentially capital gains tax treatment, depending which you might have access to depending on the assets in the wrapper. So in my view, it is something that's been spoken about a lot, and may well become a lot more popular for clients who are in the UK for whatever time period going forward. In my view, it makes most sense where you expect the wrapper to come to an end, or to unravel the wrapper once you've left the UK. For somebody who's not expecting to leave the UK in the future, and some of our clients are in that position, they've been saying we don't need to leave to make sure we are non-domiciled. So if they are remaining in the UK, potentially other options might be more attractive.
Thanks to hear. Could we have the next slide, please, Jordan? So if you've got any questions, these are the willing volunteers to direct them to. That's their detail. Also, thank you everyone for coming. I hope it's been informative. And as I say, if you've got questions, do shout. The annual conference is scheduled for the 13th of June. If you haven't booked, do please make contact to secure your place in good time for the 13th of June. If you are a tax line subscriber, your firm does have 2 free places, so it'd be great to see as many people as possible. And all it leaves me to say is thank you very much for coming, and have a wonderful rest of the afternoon. Thank you very much indeed.